a speaker.
It says it's a Shure, so I would think that's a speaker.
Oh.
A microphone.
You went
That's
red.
what I was about to say, but
It's a microphone.
Mhm. It's huge.
We're gonna call the meeting to order. And we have all of our members here today. We also have Pat Moon with Meridian Investments, who is going to present. Did everyone receive the minutes of the June 8th meeting? It's,
I make a motion to approve.
okay.
I seconded it the last time. Second.
Okay. All in favor?
Aye.
Aye. Motion carries. And Pat, so you don't have to sit through everything else. I'm gonna let you go ahead and present.
Okay, thank you, thank you. We'll turn into the book here, page 1, and talk about things. We've had worse quarters as a group in the past, but this was pretty remarkable. The second quarter was enough to make it one of the worst 6-month periods that we've ever experienced in history in the markets. Usually I'm talking about when things are worse, just talking about the stock market is down. But it's been not quite as noticeable, but it's more remarkable that the bonds have had their worst start ever to a year, ever. And the stocks had their worst first half in more than 50 years. If you look on page 1, at the top left here, just this first chart just shows a lot of different measures of buckets of whatever. The WTI, that's oil, up 39% in the first 6 months. As you can imagine, we've all seen that when we go get gas. The dollar's stronger. Nikkei, that's the Japanese market. Dow Jones Industrial Average down almost 16. European stocks down almost 17. S&P 500, that's kind of what we use as a benchmark for the broad U.S., down 21. NASDAQ down 30, and then Bitcoin, if you're interested in cryptocurrency, down 60% in the first 6 months. So that was pretty tough 6 months in those assets, and I'll talk some more about that. You know, in our business, I think it helps, and we try to do this way. We try not to be too doom and gloom when things are the way they are, and always look for reasons to be optimistic. And I think there's still quite a bit of reason to be optimistic. But it's been the first 6 months been a pretty tough time. Bonds, I've been telling you this for a long time. I've not witnessed it very long in my career either, because this is the worst start to the bond market since 1982. Okay, I started my career in 1987. So if you think about what's common between the late 70s and early 80s and what we're having now, it's inflation. And we had the big spikes up in inflation in the 70s. You guys are too young to remember that, but it very similar environment to what we're doing. And when interest rates go up, they go up for a lot of reasons, but they go up because the Fed's kind of pushing rates up. Inflation makes you demand higher interest out of your bonds, all those things. Interest rates go up, the prices of bonds go down. So we've seen that in short periods of time, but we've not seen it in this magnitude in this short period of time. I've been talking for 2 or 3 years now about interest rates need to go up. I just didn't know they were all going to do it in one quarter or the first 6 months. So if you look at this bottom left-hand chart, very bottom of that, I've got a red box around that year-to-date total return minus 10.35%. So that's your asset class. It's usually pretty safe, and usually when stocks go down, it goes up, kind of buffers things, but it certainly didn't this time. So bonds have had a tough time. And in this top right part is that this is just a measurement of kind of a balanced portfolio of 60% stocks, 40% bonds. It's kind of common in our industry to use that. Your portfolio has always been a little bit more in stocks than that, up as much as 80. We did cut it to 70 before all this happened to help just a little bit, but 60-40. So you can see that minus 16.1% rate of return. That's the worst 6 months that we've had since 1976. And that your portfolio is down 16% right on top of that for that same period. So having said that, it makes you think about, well, where are we now? And what are we looking at going forward? The markets are forward looking. The stock market isn't where it is because of what happened in the last 6 months. It's already happened. And so now we're trying to figure out, well, what's going to happen over the next 6 months? I pulled these charts this morning. They're a little bit rough looking, but I wanted to show you because this top left chart shows you inflation. The consumer price index for June measured up 9% year over year for the month of June. Very, very, very high rate, but it was expected. It was more than what was expected. I think about 8.6% was expected. And we're feeling that. You're feeling that when you go to the gas pump. This index includes gasoline and food. If you take those two things out, I kind of hesitate to take them out because we all use gasoline and we all eat. But when you take those things out, inflation's running between 5 and 6%. So that's was anticipated, and now we're trying to figure out what's to happen next. It looks like we're on the kind of peaked on inflation, and maybe it's coming down on the other side. And these other three charts I want to show you. There's the futures markets where you can buy securities or baskets of things or whatever, and based on what you think they're going to be in 3 months, 1 month, 2 months, 3 months, 6 months down the line. So the futures markets, and they're on just about everything. But this top right-hand chart shows you the future markets for all of these things: oil, gas, soybeans, wheat, corn, copper, cotton, lumber. Really good broad measure of a lot of things that are used across the economy. And this, look what happened in the month of June. I mean, investors are thinking all of these things, prices of all these things are going to come down, not just some, but probably dramatically. Maybe beginning right now, we're already beginning to see that a little bit. If I look at the bottom left, that TIPS is Treasury Inflation Protection Securities. Those are bonds. And so the bond markets are telling us, well, we think inflation is going to be way lower than it is now, maybe down to around the 2.5% level. And then gasoline, even gasoline futures, I know that's really small. I was trying to cram it all into this one place, but down to $3.18 a gallon. So we probably should see gasoline prices maybe even considerably lower than they are now. And they've already begun to, if you've noticed, they've come down quite a bit in the last couple of weeks. So the markets are kind of telling us maybe this is inflation is behind us. And that certainly will help. On page 3, I usually show you kind of what the Federal Reserve is doing by tightening. By tightening means they're trying to make financial conditions harder to produce economic activity. So why would they want to do that? Well, there's a balance. You don't want it to be too hot and too cold. Right now it's too hot with inflation. They're trying to get that inflation down. So the Federal Reserve is trying to think, okay, well, how restrictive can we be without throwing us into a recession? I mean, it's like a big battleship. You don't turn one of those things on a dime. So it's something that we've never seen happen before. They put so much money into the system. We've never seen them take it out, so we don't really know. But this is several different what they call cost conditions index that includes things that can be restrictive. The dollar going up is restrictive. Oil prices being high is restrictive. Long-term rates, and that's bond interest rates being higher, that's restrictive. Gasoline prices being at $4 to $5 a gallon, that's restrictive. And then the Fed is just one of these. So all of those things that are happening have a way of dampening economic activity. So our economy shrunk in the first quarter. We don't know whether it did in the second quarter, probably not. What we're trying to figure out is, all right, are we getting ready to tip over into a full-blown recession? And if we are, how deep and how long will that be? On page 4, I just showing the interest rates. One of the reason people aren't being more, including us, definitive about going into a recession is because the labor market is so strong, so strong. We never have gone into a recession with unemployment at 3.6%. And by going to restaurants, and if you travel the airline or how much trouble people are having to get workers, you probably are too in your businesses too. So that's given the Federal Reserve some room to be more restrictive without maybe throwing us into recession. Maybe it's because we're at such strong employment. People aren't out of a job yet. And so that's a really, really positive thing, but it's also causing, some questions about what are we doing next. On page 4, I just wanted to show you the sharp increase of interest rates. This is the yield curve. So this is Treasury interest rates, and the maturity in years is at the bottom. So There's a 1-year maturity, and you go up there, and that's the rate on those 2, 3, 5, 6, 7, 10, 20, and 30. I usually talk about the 10-year rate, but you can just see, for instance, the 10-year over the last little over 6 months has gone from about 1.5% to 3%. So it doubled. You think, well, that's not much in absolute terms, but in percentage terms, we've never seen it really before. So that's happened across the board. One thing you might also know is that if you ever hear somebody, you probably won't, it's probably just me talking about it in here, a flat yield curve. That means, you're getting about the same on a 2-year treasury interest as you are a 30-year treasury interest, okay? That's not unusual, but generally when you're going into a recession, it'll invert, which means the 2-year rate will be higher than the 10-year rate or 30-year rate. And so why does that happen? It's just that people are anticipating interest rates to go down, so they'd rather own a longer term one than a short term one and lock in the higher rate. So it's not happened yet, slightly inverted, but we don't really know about that. I think, a year or so ago, we would have said, well, we need interest rates to go 4 or 5%. It just doesn't look like that's going to happen. Maybe we're as high as we're going to go for a while. It's given us some opportunities to buy bonds at 3 and 4% instead of 1.5% and 2%. So that's good for the fund. But maybe we're not going to see quite all that. On page 5, I found these actually just yesterday. Expectations are pretty negative across the board, and it's hard as a consumer not to feel negative because you're seeing all these things. I heard on the news today where the average American is spending $500 a month more now than they were a year ago just to live. And that can be food, it can be gas, it can be mortgage prices. It's probably not quite so that in our state as it is some of the others, but $500 a month extra is a lot. And so this was a survey done by CBS News about 3 weeks ago about consumers and kind of what they're expecting. Expect the U.S. economy next year to be, booming, not many. In recession, almost half of the people are expecting that. Saying the economy is bad. January is 64%. Now, all the time, a lot of people say the economy's bad, regardless of how good it is. So you got to take that into consideration. But now 75% are saying that their own financial situation versus a year ago is, a lot more bad than it was last year. And then feel about your ability to afford things today. You can just see pretty big jump about altering plans. So the consumer is 70% of our economy. What you and I spend is 70%. So what consumer behavior is a big deal when it comes to economy. It can kind of become a self-fulfilling prophecy. If you feel so bad, you start cutting back, and you cut back, and you cut back, everybody cuts back, and all of a sudden the economy tips over into recession. So we'll just see how that goes there. So I'll end this part. I just wanted to leave you with a little bit of good news because there really could be. But I found this dominoes falling chart kind of interesting. The things that have already happened, and I want to say that because the markets aren't thinking about what has happened before. Like I said a few minutes ago, they're thinking about what's going in the future. So the dominoes are falling. We know stock prices, they're not rising anymore. Manufacturing is beginning to fall a little bit. Yield curve flattens. Consumer confidence falls. Price earnings ratios on stocks have fallen. All of those things, and then we've got labor market weakens. That really hasn't happened yet. Maybe in certain parts. What we're really thinking about the stock market is what companies are getting ready to say about their earnings. They report quarterly generally. So the first 3 weeks of every quarter, all the companies come out and report their earnings from the previous. So everybody's kind of expecting it to be okay, maybe down a little bit. What's really key is what they say about their expectations for the next 6 months. So a lot can change in the next couple of weeks based on what companies say. I think it's natural for companies to maybe be a little more reserved about what they expect. There's not many going to be out there being really bold about what their earnings are. So we just hope that they don't come out and say we're seeing trends of they're really falling off the cliff. So we've got that to go. And then on the bottom right hand, this is a leading economic indicator index. It just kind of takes this basket of different economic indicators and said, what does it look like for 6 months down the road? And the level currently is fair to strong almost across the board. So we're in pretty good shape now. But the trend, you can see we're getting a lot of yellow and red on that. So it's not a perfect indicator, but it is one where you kind of gotta think about that. So the economy is definitely losing momentum. These are the troubling things. Inflation is elevated. Most likely, it's peaked. I'm not saying it's going to go down to 2%. We've got a lot of stuff to work through, but it's not going to be at 9% either. The Federal Reserve is raising rates, and they're really doing so aggressively, and company earnings should weaken. So the things that we've got to be optimistic about is we're really watching the labor market, see what happens with employment going forward. You know, bonds where we had terrible rates to buy before, now we have decent rates to buy, so that helps the portfolio. And the value of the stock market as a whole is below its 25-year average. So this big drop that we've seen, 20% in the first 6 months, that could be it. It could have said, okay, we've discounted all this bad stuff that's going to happen, and I don't think it's going to immediately jump back up and go back up like it did, but we'll probably spend the rest of this year, my guess is down 15 to 30%, somewhere in that range. And if it sells off here in the next couple months, we'll take it back up closer to 75% in stocks. We want to be ready for whenever it comes back. Okay, I could have put in 15 pages of charts, but since there's so much stuff, and I spared you some of the any questions about all that? Okay, well, let's look at your portfolio on page 7. The top green bars are the total portfolio. You can see down almost 12% for the quarter, 16% year to date, about the same as last year. I think it's interesting, even over the last 10 years, if you take that, and it was down in 18, and the market was down in 15, it was down big in 12, you still got a 7% annualized return over 10 years, which is right at your actuarial rate of assumption. So that's why you stay in the stock market like you do. The bonds, you can see our performance is negative 3.1 versus a government bond index at minus 1.3. You're probably used to that, aren't you? I don't get that sound at my office. So we're investing in some corporate bonds, which will perform a little weaker down now, but you can see it really pays off over the long term. I think it's incredible. And we're looking at 1.2% annualized return for 5 years and 2% for 10 years. You can see all of your returns have come, almost all of them, from stocks in the past. And then for the quarter, your stock's still a little bit better than the U.S. markets. The foreign stocks actually began to help us just a little bit. Everything's down. Small company stocks, that's the Russell 2000, and NASDAQ stocks, a lot of technology companies. Anybody know about the ARK funds that Kathy Wood? Famous money management firm, manages billions of dollars, and they've got these funds that are invested mostly in technology. And of course, they were star performers over the last 10 years, 5 years, I mean, by a long shot. Those funds, there's about 5 of them have been down between 50 and 70% year to date. So if you're a solid technology investor, it's been a pretty tough time. Yeah, it's been a pretty tough time. So your portfolio value took a big step down over the last 12 months. You can see $13,450,000. And lastly, on page 8, you catch your breath. We have you about 69% in stocks. We'd like to have you, 75 or above, really. So we do have some cash there, 6%. So we're ready to buy some things. We've not been very active at this point. To be honest with you, there's so much uncertainty. There's been a lot less volatility because it's kind of stunning. People don't really know, including us. We don't really know clearly what to say we need to buy right now. There's a lot of good companies out there that are a lot cheaper, We don't know if they're gonna be cheaper. So we've not been real active, but when what we have, what's called a capitulation, you may feel like we've had this already. Capitulation means all of a sudden markets start selling off big every single day for weeks at a time. That's where capitulations throw in the towel. I'm getting out. That's where we'll have a sign where we say, okay, we've got to be buying here. You don't want to get it. You can't get it perfect, but you want to be buying at a time like that. And you look back in a couple of years from now, and you say, well, that was a pretty good time around that time. We've not seen that. Maybe we don't get it, but if it gets worse, that's where we'll be active buyers. We sold Disney during the quarter. It's not weaker economy, and there's a lot of things going on in the company that just didn't pan out that we want to get out of. And Align Technologies is a new investment for us. We took a small position. It's in lieu of braces. Yeah, orthodontists and doing it now instead of taking your kids in and getting them tightened up each one. I don't know how they do it now. That's how they did it 45 years ago. And we have taken your bonds up to 25%. It was below 20 at one time. So we've been buying bonds at higher rates, these higher rates there. And then your portfolio beginning on page 9. Y'all are a lot more talkative when things are going well.
How long has Align been public?
Let's see, probably maybe around 5 years.
Really?
Maybe it's 5 years. It's not been big enough for us to buy.
Yeah.
The company's gotten big enough. And it's a pretty cost-effective way to get and dentists do it, and not just orthodontists, dentists do it as well, and you can also do it at home.
Yeah.
We think there's a lot of opportunity in England for it.
Recently, I saw one of those,
So I knew what I was talking about.
one of the trays, I guess, some of them, there was one like laying in the parking lot. I don't know if it was one they were done with, ready to move on to the next one, and they thought, well, we'll just,
Where they're gonna start looking for it, yeah.
Yeah. What
Part-
that,
reuse. Yes, you could.
but that
See
used
if
to
it's
be,
tight.
when my boys were young, that might be their retainer line in the parking lot. I'd get home and we'd have to go home and pay $250 for a new retainer that they quit wearing and when they get out of braces anyway.
Mhm.
Not that I'm bitter about it, but girls don't do
Those
that.
days.
Girls don't
Well,
do that.
yeah, well, they do.
I know girls that wear theirs their whole life.
I think I saw a news report that inflation in the United States isn't as high as some of the inflation rates worldwide, which,
A lot of emerging market places have a lot more trouble with inflation all the time. All the time. Yeah, than we do. This is big for the world's largest economy. It's big.
I read an article that basically said that when inflation gets a little out of hand, that historically, you don't get that under control until interest rates at least meet where inflation is. Is there any truth to
No, that's
that?
exactly right. I could, in fact, I looked at a chart of that when we were putting this together, but that's what the Federal Reserve is trying to do, is getting the inflation down to about 2.5%, which would be close to where the 10-year Treasury interest rate is, around a little under 3%. So that's what their goal is, to do that.
Read that for the first time in like 20-something years, the euro and the dollar are now like equivalent.
That's right.
Is that the dollar being good or the euro being bad? Or
It's the dollar being good. The only time they've been equivalent dollar for dollars was when the euro first came out. But generally, the dollar is stronger than other currencies because the U.S. is the strongest economy in the world. And it works, oddly, it doesn't really seem like this, but it works just in the reverse. So when the dollar is really strong and other currencies are weaker, the dollar buys a lot more of what their currency will buy. Yeah. So other currencies like the euro has been close to ours, so we wouldn't be able to, quite a bit under ours, so it didn't convert as well, but now those currencies are more equivalent. So I guess what I'm saying is now is a good time to go to Europe. Yeah. Yeah. So
your dollar could buy more.
your dollar can buy more. they're good than it could have, yeah. Yeah, it's a really good time to travel, and it's a terrible time to travel. Have you been noticing on the news and pictures of suitcases filling up the whole terminals and things like that? I've heard people flying back without their bags and haven't seen them for weeks.
So when do they think there might be some type of, if are we just fingers crossed we've peaked out and?
For inflation? Certainly, fingers crossed, certainly, but it just looks like everything's kind of rolling over. We're beginning to get a handle on something, and maybe we've seen the worst. But inflation's not gonna go back down to 2 or 3% anytime soon. It's still gonna be elevated for some time. A recession, good old-fashioned recession would accelerate that, would make inflation come down quicker. They're trying not to do that.
I've never seen gas prices as volatile as they
Fluctuate
have
so
been.
much.
Like they used to change 2 or 3 cents at a time, and now it seems like it's like a dime. And I can stand, when my road comes out on Highway 65, I can stand at the end of there right now, and I can look to the right and to the left, see 2 different gas stations, and there is, as of last night, there was 25 cents difference between the two.
Oh, really? Gas stations retail, they get a really bad rap about changing the gas price really quick when rates are going up and not so quick, but there probably is a little bit of profiteering in that. But you know, if the price of oil and gasoline goes down where they buy it pretty quickly, they've got a whole underground storage tanks full of gas at a higher price.
Mm-hmm.
So they can't really drop unless they want to take a loss, which most of these retailers, they only make it between 2 and 3 cents a gallon on gas, generally. Most of what you're paying goes to the producer and to taxes. So it's not a loss leader, but they can't afford to keep it on a while.
You're welcome to join us.
You know, in our country, we've got, on the good side, we've got the ability to drill more oil and completely meet all of our needs. Because of this fracking, and we've got a whole lot more oil, we could be completely self-sufficient. What the problem is we can't build any more refineries, which make the gasoline from oil. 30 years ago or so, we had 12 refineries in the country, and today we have 8 online. We haven't had any new ones built in 30 years because they can't get them passed.
And they decommissioned some during COVID.
That's right.
They're saying it's, with the push for green energy, they're not willing to make the investment to bring those back online just yet.
Yeah, it's just cost prohibitive to build one with the EPA requirements that's on it now. And then they're hoping we don't have a hurricane that knocks one out in Florida, which make things a lot worse. So even though we could produce enough oil to meet our own demand, we can't produce enough gasoline. So I don't know what the answer to that. Those are big problems. So we'll see. We're still importing other people's oil instead of using ours, all of ours. So I don't think we're going to see gasoline prices go back to $2 a gallon probably anytime soon. Just don't see that happening. Gasoline really, it's $4 is not, but $3 gasoline is less really adjusted for inflation than it was 25 years ago.
Mm-hmm.
It's been pretty constant cut out of people's pocketbooks.
That interests me how different things, how the prices of them change through the years. Back in the 80s, a good television was $1,500, and today a good television is $1,500.
That's right. A really good television.
Yeah.
Yeah, really good
Yeah,
television.
you can get a good enough one for half that.
Yeah. Yeah.
I saw people complaining that Little Caesars had raised the price on their $5 hot and ready, and it was like $5 for like 20 years. That's pretty good.
Yeah, no doubt. No doubt. Tires are the same, tires, think how much better a tire is now than when we were, young, changing flats all the time. All the time, so. Inflation is really personal to each person, what you're spending your money on. If you drive a lot, it costs you a lot more. It used to be when you sent your kids to college, that was, healthcare is still inflation, it's been high, it's been growing a lot.
Yeah, so in the last year, I went from a Honda Accord to a GMC Sierra, and my gas and my tires, just researching what the tire, I used to could put a set of tires on that Accord for, like under $400. And if I looked at it for a truck, before I even bought it, I was like, oh my gosh,
Yeah.
that is.
Yeah, probably $300 a tire.
Yeah, it's
Yeah.
staggering.
For that.
My sister bought a Tesla, and that thing slipped. I don't know. That thing's like driving an iPhone around. But
Yeah.
it's like it's crazy. But she ain't paying for the gas prices right now, so I'm kind of
that's good. There's not going to be just like this turnover. We all go to electric vehicles, because the charge only lasts for about 300 miles.
I think she could get that one. She lives in Little Rock, and we were down in Southwest Arkansas back at our home, and she had a 350-mile range on it.
Yeah.
Which is basically like a tank of gas,
Yeah.
It's the infrastructure though, to get to a charging station, a fast charging one.
Yeah.
So
Yeah, the fast ones get it because we were at, our house, and if she plugged it into the 110, it would be like an all-night charge. But at the shop out back where the welding machine's plugged in, the 220, that can get it in that's still like 4 hours, it cut the time in half.
Yeah.
But, once they get the infrastructure up, is the kind of like you say, the hold up there. But I've always wondered, like, if everything went electric and the power grid went out, would everything shut, like like in a city, like New York or something, would all mass transit, everything just shut down, or?
Yeah, I don't know.
That's what's for this meeting.
Yeah, I know.
I watched a video of a real world, I guess you'd call it, test on the electric trucks. And they hooked it up to a camper trailer. It was able to go like 86 miles.
Yeah.
Before they had to stop and recharge.
Yeah. Yeah, there's, beyond just us kind of driving around town, there's big issues with that. That's going to take years. But plus, those batteries use lithium, and there's a limited supply of lithium. It comes from the ground, and we're finding it. In fact, I read this morning in the paper that El Dorado,
on the
got a
paper
big one down there. I think they can make 50 million cars with that or whatever. But we're not just going to turn on. Plus, oil, is used for, it made this and this and this and this and this, that, and everything we have comes from oil. So there's not going to be this, we're not using oil anymore.
It's a known finite commodity, so at some point, we're gonna have to change to something.
Yeah.
Something's gotta give.
I don't know the answer.
Maybe not in my lifetime, but
Yeah, I agree. We're trying and making remarkable progress that way. I saw in India, there's a company that is making asphalt from plastic jugs. The company's based out of Sweden. It's not investable. I've already checked in that. But it can make asphalt from recycling plastic. But that seems like that's the answer to so many things. And the roads last longer, and they're incenting people in India to bring in, they're paying them for the jugs and things like that.
Hence why you looked into it.
I didn't.
That's funny.
Yeah, because I looked at it. Yeah, just can't, not a stock yet. Not a
so
stock.
Pat, we will let you make this up to us next time.
You will?
Yeah.
Okay, okay. Well, having said that, I'll go right now and get to work on it. All right.
Thank you,
Good,
Pat.
good to see y'all. Thank you.
Hope you bring us better news next week.
Well, it's likely. There's a good chance it'll be better, but.
We appreciate your bravery nonetheless.
Yeah, I know.
Now's the time to buy.
See y'all.
Thank
See
you.
Bye.
Bye.
You're going with this still, right?
I think we all were kind of expecting that.
Yes.
We have several refund requests. Mandy Cates, $14,241. Shelby Fitz, $5,509. Russo, $9,914. Philip Bell, $11,039. Kyle Spears, $4,841. William Hamilton, $8,473. Cameron Woodfork, $5,850. And Daniel Suits, $490. The total amount with is $60,362.66.
You got the cash to do that?
Second time this year we've had. We were able to about 80 grand one month.
Yeah, it was 26 last month. It was 31 the month before. We've had quite a lot.
How long did these people work for us on average?
Mandy had been with us a long time. She was the admin at sanitation. She's been with us for quite some time. She was in the old plan.
Mm-hmm.
Less than 10 years,
Yeah,
but still like probably 7.
yeah.
I think the highest on that list is Mandy, and then there's 3 or 4 that have about 2 to 3 years under the belt. The rest are
Pretty Smith.
Well, I make a motion to approve.
Excellent.
Second. Yeah, to answer your question, we've got like the bank sitting at about 220 right now.
Okay. All in favor?
She did a good job.
Aye.
Aye.
Aye. Motion carries.
Yeah, and when she did make a mistake, she was able to find it pretty quick and.
It will help the fund in the long run.
Because that's people getting off of the old plan and new people being hired into the new plan.
Yeah.
Well, we're
We can hire them.
4 years into the new plan now, so those that were less than 4 years, it doesn't really help us any.
No.
Mhm.
The one more than 4, theoretically it does.
And there was no way to transition people from old plan to new plan. I know we probably already covered that, but
Legally, we couldn't do it. There was some laws that.
IRS regulations prohibited it.
But yeah, we looked into that at the time.
And now, do you have any other business?
No, are you gonna talk about the, did you have something?
Well, the actuaries asked to be pushed back.
Oh, did they? Okay.
They had their schedule was getting pretty full around that August, the 23rd or something, whenever that council meeting is. So we're gonna have them in committee meeting at the council meeting on September 13th.
Maybe by then we'll have a little improvement
Maybe.
on this side too.
One thing, we had talked a little bit about exploring the possibility of not making
Participation
mandatory.
mandatory.
We're gonna wait until after the actuary presented to the council before we looked into that further, or?
I think that question wants to be asked of them.
Okay,
And that committee meeting's probably as good a time as any just to get their initial thoughts on it.
I know that, well,
Could they have any potential illustrations of the impact by then?
I can ask them.
I mean, nothing fancy, just, if, say, 10% of the people said didn't want to participate, what would that look like?
Mhm.
Just to give, because I know sitting there, it would be difficult to really kind of think it through without knowing, well, what are some of the ramifications of allowing it, not allowing it?
Yeah.
yeah,
And it's a different, I mean, on the old plan, we had people that opted out, but it was probably, I mean, we had over 200 participants and there were, I'd say less than 10
yeah.
that opted out, but now there might be more just because it costs more.
Yeah,
the deduction's
And,
higher.
and,
Well-
or if they could identify a tipping point where if it reached a certain percent,
With the
Go ahead.
council addressing some of the low entry-level positions, I think that's where you would have really found some people maybe not wanting to participate, but with the council adjusting that, I think it's gonna make people hold on or opt into the plan
Yeah.
because it's not as big of a deal.
It's 10%, and this is what I'm hearing from my directors in the departments, where the pay is lower
yeah.
overall.
It's a
They have
big-
more lower
That is a
pay
big-
employees.
that is a big-
It's the same for ours for sure, but now that that adjustment is in, I don't think you're gonna hear that as much personally. Or at least in our department, I think that's the case.
That'll be good.
Mhm. All right.
Anybody else have any other business they want to talk about? Or don't want to talk about? I would entertain a motion to adjourn.
So moved.
Second.